And what's up, good people? How you doing this morning? This is Larry Jones, and welcome to Stock Up. If you're new to the page, go ahead and follow the prompter by hitting the like, subscribe, and notification bell. For those that rock with me, go ahead and hit the like button. Hey, we have this Jackson Hole meeting today. Fed Jerome Powell will be speaking at the annual, let me say this right, Federal Reserve of Kansas City annual gathering in Jackson Hole, Wyoming. In Jackson Hole, Wyoming. So he's going to be speaking. We're expecting what he says to move markets, and hopefully he doesn't go too hawkish. We're going to only be on for 20 minutes. I'm going to say hello to you guys in a minute. Let's look at where we are. Look at that. So as you can see, pretty flat right now. All right. We'll take it though. And so what I'm going to do, as soon as he comes on, he should be on in 5 minutes. And I'm going to go and we're going to stream the first 20 minutes. The first 20 minutes. That's all. No one knows where the bottom is, but we know we're not at the top. All right. So for those of us, I don't know, I write these things down sometimes sometimes the simplest things just hit you like boom. All right. Hey, so what we got going on here? Good morning, good people. Yep. Good morning. Good morning. Good morning. Michael Jones. I got a brother named Michael Jones. What's up, Mike? Hey, how you guys doing? San Fran. Hey, I'm gonna come through there on my way to Hawaii. What price level are you looking for Tesla split? The Tesla split is no big deal. Right now in this market, it's not a big deal. It's the price of the stock or the value of the company is worth the same. It just makes it more affordable for people. It's a mental thing, so it's not gonna do anything. Hey, Nola. Hey, what's up, Nolans? How y'all doing? Good morning. Where we from? Good morning. Bottom is in? Let's see. Honduras. What's going on? What's going on, Leon? I was trying to find it coming in so quick. I was trying to get it. Do you have any position in for today? Not really. I don't have any big positions in today because it's just we don't know what the Fed is going to do. We believe that the next interest rate hikes will be between 75 basis points and 50 basis points. So I really don't have anything going in right now based on what I think he's going to do. Why even risk it? I mean, let's face it, anything could happen. He could say, hey, we're going 75 for the next 2 months and the stock goes down. He could say we're doing 50 and maybe 50 and then 25. I believe the stock will be good. Yep. Yo, what's up? Yep. Oh, Sydney, Australia. That's one of the places I got to get to. I want to go to Sydney, Australia on the first day of the year to see the fireworks. Right. Bottom is, I believe so. I believe so too. The bottom is not in. We got plenty of room. I believe so too. It's just what I believe. I may be wrong. Let's see what the markets say. Remember, we're not going to argue with the data. We're just going to do what we do, right? What's up, my buddy? What's up, Charles? How you doing this morning? What's up? What's up? Hey, where we from? All right, let's get some coffee cups going. My man. My man. New Orleans in the house. All right. We need to return. Hey. Yes, sir. Marco Garcia. What's going on, man? Yeah, I got to come back. I got to get back there, man. Maybe next conference. Luna, I don't know. Larry, to start. Wow, I'm sorry. It's going so quick. Hey, what's up? What's happening? All right. Let's see what they're talking about. Let's go right to it.
Fed Chair Powell is going to address the economy, rates, and a lot more. We, of course, will take you there live as soon as he begins to speak. Good Friday morning, everybody. Welcome to another hour of Squawk on the Street. I'm David Faber with Leslie Picker and Mike Santoli.
Hopefully he's not too delayed, because we're only going to air the first 20 minutes. Sometimes they talk. Here we go.
We're going to take it right now.
I have discussed broad topics, such as the ever-changing structure of the economy and the challenges of conducting monetary policy under high uncertainty. Today, my remarks will be shorter, my focus narrower, and my message more direct. The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The burdens of high inflation fall heaviest on those who are least able to bear them. Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. The U.S. economy is clearly slowing from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. While the latest economic data have been mixed, in my view, our economy continues to show strong underlying momentum. The labor market is particularly strong, but it is clearly out of balance, with demand for workers substantially exceeding the supply of available workers. Inflation is running well above 2%, and high inflation has continued to spread through the economy. While the lower inflation readings for July are certainly welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down. So, we are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.25% to 2.5%, which is in the Summary of Economic Projections range of estimates of where the federal funds rate is projected to settle in the longer run. In current circumstances, with inflation running far above 2% and the labor market extremely tight, estimates of longer run neutral are not a place to pause or stop. July's increase in the target range was the second 75 basis point increase in as many meetings, and I said then that another unusually large increase could be appropriate at our next meeting. We are now about halfway through the intermeeting period. Our decision at the September meeting will depend on the totality of the incoming data and the evolving outlook. At some point, as the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. Committee participants' most recent individual projections from the June SEP showed the median federal funds rate running slightly below 4% through the end of 2023. Participants will update their projections at the September meeting. Our monetary policy deliberations and decisions build on what we've learned about inflation dynamics, both from the high and volatile inflation of the 1970s and 1980s, and from the low and stable inflation of the last quarter century. And in particular, we're drawing on three important lessons that I'll highlight. The first lesson is that central banks can and should take responsibility for delivering low and stable inflation. It may seem strange now that central bankers and others once needed convincing on these two fronts. But as former Chairman Ben Bernanke has shown, both propositions were widely questioned during the Great Inflation period. Today, we regard these questions as settled. Our responsibility to deliver price stability is unconditional. It is true that the current high inflation is a global phenomenon, and that many economies around the world face inflation as high or higher than seen here in the United States. It's also true, in my view, that the current high inflation in the United States is the product of strong demand and constrained supply, and that the Fed's tools work principally on aggregate demand. None of this diminishes the Federal Reserve's responsibility to carry out our assigned task of achieving price stability. There is clearly a job to do in moderating demand to better align with supply. We are committed to doing that job. The second lesson is that the public's expectations about future inflation can play an important role in setting the path of inflation over time. Today, by many measures, longer-term inflation expectations appear to remain well anchored. That is broadly true of surveys of households, businesses, and forecasters, and of market-based measures as well. But that is not grounds for complacency, with inflation having run well above our goal for some time. If the public expects that inflation will remain low and stable over time, then, absent major shocks, it likely will. Unfortunately, the same is true of expectations of high and volatile inflation. During the 1970s, as inflation climbed, the anticipation of high inflation became entrenched in the economic decision-making of businesses and households. The more inflation rose, the more people came to expect it to remain high, and they built that belief into wage and price decisions. As former Chairman Paul Volcker put it at the height of the Great Inflation in 1979, inflation feeds in part on itself, so part of the job of returning to a more stable and more productive economy must be to break the grip of inflationary expectations. One useful insight into how actual inflation may affect expectations about its future path is based in the concept of rational inattention. When inflation is persistently high, households and businesses must pay close attention and incorporate inflation into their economic decisions. When inflation is low and stable, they are freer to focus their attention elsewhere. Former Chairman Alan Greenspan put it this way: for all practical purposes, price stability means that expected changes in the average price level are small enough and gradual enough that they do not materially enter business and household financial decisions. Of course, inflation has just about everyone's attention right now, which highlights a particular risk today. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. And that brings me to the third lesson, which is that we must keep at it until the job is done. History shows that the employment costs of bringing down inflation are likely to increase with delay, as high inflation becomes more entrenched in wage and price setting. The successful Volcker disinflation of the early 1980s followed multiple failed attempts to lower inflation over the previous 15 years. A lengthy period of very restrictive monetary policy was ultimately needed to stem high inflation and to start the process of getting inflation down to the low and stable levels that were the norm until the spring of last year. Our aim is to avoid that outcome by acting with resolve now. So, these lessons are guiding us as we use our tools to bring inflation down. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we're confident the job is done. Thank you.
It was Fed Chair Powell delivering his remarks, and let's just get right to it here on the desk, Mike and Leslie. I mean, the market taking a reaction saying, again, we're going to stay at it until the job is done, perhaps hawkish for longer.
The emphasis certainly on the restrictive nature and how the Fed feels like it needs to be much more resolute in conveying the idea that they're going to wait until inflation gets down. A restrictive policy stance for some time. It's going to require some pain. The labor market, he pointed out again, is strong but out of balance, meaning he feels as if the Fed's tools, which attack consumer demand, have to be applied on that side and on softening up the labor market. On the other hand, it's not out of the range of the messages we've been getting already. And so there was not a lot of specificity.
So there we have it, good people. I mean, it's like I thought yesterday. I said it on yesterday's video that I believe that the market has priced in a lot of this. I'm glad he kept it short. It's almost we were losing a point per word. So every word he was saying, the dial was just ticking down. And I know you're like me. You just want him to be quiet and go away. Respectfully submitted, Mr. Powell. You don't have to go home. Just go away right now. Just stop talking. But I understand his job is to, it's a balancing act. The more hawkish he sounds, the less hawkish he has to be. So if he's very hawkish right now, and a lot of business owners think that, he's going to be hawkish, so they're going to start operating more, you know what I'm saying? They're not going to hire as much, which is not good for the jobs market, but they're going to operate more leaner. So the more he can do verbally, which this Fed has done really well, and there's stuff that he's done a horrible job at. So if he could verbally cause the fear and cause inflation to slow down, that is actually a tactic that actually does work. He's not the first Fed. A lot of Feds do this. So if you really follow Jerome Powell, he'll be in a meeting and he'll be dovish. And then off the cuff, he'll say something very hawkish. And then vice versa. He'll come out and say something hawkish in a meeting, in front of the Senate. And then next thing you know, he'll make a dovish comment. And so he's trying to do this balancing act. I'm glad I don't have his job. All right, so we're going to keep this one short. I'm glad he didn't talk long because our stocks was paying for every single word. It costs when the Fed speaks. All right, looking like, yep. And so I'm glad he kept it short. And what do you guys think? I think you might be. Well, let me tell you this. His job is not to balance the stock market. His job is the economy. The economy. And it's such a balancing act to sometimes the stock market has to take a hit to level off the economy. They're trying to get to 2% with inflation. It's just going to be difficult with inflation running high as it is. For those of you that don't know, for a Fed to do 275% basis points is really, really, really hawkish. A lot of people don't know. If he comes back next month and says another 75 basis points, right? Which he may. That hasn't been done, good people. That just hasn't been done. 50 basis points is a lot. So now we're used to these hawkish interest rate hikes, right? So a mortgage right now, as of today, for a 30-year fixed mortgage is 5.5%. The average house that costs $250,000 now is paying an extra $300 a month for a mortgage payment, okay? And so that's what these interest rate hikes do to combat inflation, because the demand slows down. And so that's happening all the way around. All right. So, hey, good people, I'm going to leave it right there. I just wanted to come on. I don't want to make it all about what I'm talking about. I want you guys to listen to the Fed, and you guys could see what the market did. It did come down, but not that much. It's just wasn't bad. We had a run up yesterday. So I'll call this so far a good day. Look at the Dow right now. The Dow is actually coming back. So the market has to take a minute, find out and process the information it just had, and then kind of balance out. So we'll be back with you guys this evening and see what the market does on a Friday. I am adding to my $5 a day in the last half hour of today. That's when I buy my DCA, the last half hour of a Friday. All right. All right. Good people, hit that like. Make sure you check out the links below. Listen, We only have a few days left for both of these promotions, all right? For both of these promotions, we only have a few days left. So it's running out. So we want to make sure you check out the Moo. And with my link, you're going to get 3 extra free stock. We want to check that out. And lastly, let me bring that up. We also want to check out Webull, all right? We want to check that out too. Get up to 12 free stock. I think with Moo it's like 26 up to 26,000. With Webull, 30,000, 12 free stock. Hey, that's it, good people. We will see you tonight. I love you guys. Have a blessed and prosperous day. Make today a good one, all right? We'll see you tonight. Live, love, laugh, and learn.